Let's get started. So I want to look at fraud and fraudulent behavior. So I want to go through fraud and fraudulent behavior. So what is fraud? That is the first thing. So if someone is said to be committing fraud, what is fraud? So fraud is the intentional act which involves usage of deception. So for it to be regarded as fraud, number one, it has to be intentional. So for fraud, it means you were actually aware of what you were doing. If someone is committing fraud, it's not a mistake. They're actually fully aware of what they're doing. And they are using deception. They're deceiving other people. Maybe they are lying to them so that they gain an unfair advantage. So for fraud, someone is using, number one, so for fraud, it's an intentional act. So you do it willingly, you have the intention, and there must be an aim of getting an illegal advantage. So if someone is involved in fraudulent activities, normally they do it so that they have a gain which is illegal, or a gain which is we can say, yes, a gain which is illegal. So you're taking advantage of someone so that you illegally benefit. So you're using deception because the person doesn't know, because the person is not aware. You're taking advantage of that so that you benefit at their expense. That is fraud. And fraud is regarded as being a criminal offense, or it's classified as a criminal offense. So if you're committing fraud, you're actually committing a crime. So fraud, you're using deception to gain an unfair advantage over someone. You're using deception so that you gain an unfair advantage over someone. Who commits fraud in an organization? It's not only, so fraud can be committed by different people within the organization. It's not only the employees. So fraud can be committed at different levels. Fraud can be committed at employee level. It can be at management level. So who commits fraud? Fraud can be committed by managers. It can be committed by employees. Fraud can also be committed by third parties. So let's look at the different types of fraud. Or before we look at the different types of fraud, let's have the other terms to take note of, which we are likely to come across. So let's discuss these other terms, which are also connected to fraud and fraudulent behavior. So the first one, let's quickly take that down. Let's quickly have that down. Okay, so there is a difference between an error and fraud. What is the difference? If it's an error, there isn't an intention. Take note of this one. So for an error, it is an unintentional act. For fraud, we say it is intentional, but an error is an unintentional mistake. So errors are bound to happen, especially if we are counting people and we are recording transactions that involve amounts. Errors are bound to happen. So someone can make an error, not necessarily because they wanted to commit fraud. Errors are bound to happen, and errors are unintentional. So that's what we can use to differentiate fraud and error. Number one, if it is fraud, it is to be intentional, but an error is unintentional. So if it is an error, it's unintentional. But fraud, I actually commit fraud knowingly and intentionally. Then let's move on. We have irregularities. Irregularities, these are actually used to help us determine when fraud is taking place. So as an organization, we can study the irregularities. Irregularity, we are saying something is not following the usual rule. We know every month we record sales of between 20 to 30,000. But this year or this month, we've recorded sales of 1,000. Something is not following the usual pattern that we are used to. So as an auditor, in most cases, if we hire auditors to check whether fraud is taking place or not, they can use the irregularities. They can study those irregularities, those anomalies, and check what has caused that difference. It could be fraud. It's not necessarily that whenever maybe the sales were from 20 to 30,000 each month, then this month we have sales of 1,000, then you automatically say it's fraud. It's not we can't come up with that conclusion. But irregularity can be an indicator. So it is something that can indicate that fraud might be taking place. It can be used as an indicator that fraud might be taking place. So irregularity, we are saying, is something that is contrary. It's not following the usual rule. It's contrary to the rule that we know. It's not something that is common. So that can be an indicator that something bad is taking place. It can be an indicator that something bad is taking place. Then we have misstatement. A misstatement is something that has been said wrongly, a statement which is not true. A misstatement, in the financial statements, we might find a misstatement. A misstatement is when something has not been said correctly. This can arise as a result of fraud, or it can be as a result of error. Someone can say something or write something unknowingly without any intention to commit fraud, or someone can lie knowing. So if it's a misstatement, it can be as a result of error, or it can be as a result of fraud. Then we have various types of fraud. Let's quickly have those done. Okay, so let's quickly have those different types of fraud. All right, it's fine. Types of fraud. Types of fraud. So the fraud that can be committed within the organization, we can have management. We can have management fraud. So if it is management fraud, this implicates management or it involves management. They are also part of the people that are committing the fraud. So if it's management fraud, it means the fraud is involving managers. Which are the types of fraud that normally involve management? So which are the types of fraud that normally involve management? So the first one, we can talk about window dressing. So window dressing, where does it come from? So for window dressing, this is the case where the managers are lying to the shareholders and the public regarding how the company has performed. So window dressing ndo yatiri kurohwa nevasikana vemazuva akarohwa makeup zvese zvakanyatso obva mukoma simba obva watonoti vakunoroora obva kuti aiwanda mwana murume handizvo apedza kudai so munhu akunogeza face akubvisa makeup makutona akazvikoza tafanana. So what happened is that paitika window dressing zvekuti anga achida kuattracta a certain type of market yake. Once that market has been attracted, iwewe as an investor waisa investment yako, waisa investment ndipo wakuona kuti one, but watoisa chi mari mukampani wakuona kuti those accounts ama muchipiwa anga ari maaccounts ekunyeba, they were window dressed, vanga vakabika maamounts, but now it's too late, you have already invested in that company. So that is window dressing. It's normally the management that facilitates that, because my managers, they are on an assignment from the shareholders. So the management, the directors, these are accountable for the performance of the business to the shareholders. So they want to tell the shareholders that we are doing well, even when we are not. So they can window dress the accounts. They can show the shareholders what they want to see, which is not exactly what's taking place in the company. So window dressing, that is window dressing, where the transactions are not showing a true picture of what took place. Then we have also misappropriation of assets. We have misappropriation of assets. So misappropriation, this is a case where the managers take the funds that belong to the company or the assets that belong to the company and start using them for the benefit which is not for the company or for their personal benefits. They are using the money that is supposed to be paid for the company expenditure to pay for their personal needs because they know no one is going to ask for them. So misappropriation of assets is actually a form of fraud where you are not using the assets of the business for the right purpose. Or you allocate the assets. Sometimes you might use the assets for the purpose, but you are misallocating them for your personal benefit or for the benefits of your friend. So your friend doesn't deserve to be given the resources, but you are giving them simply because you're the manager. And those that deserve to be given the resources, they are not being given the resources. They are not being given the resources. So that's misappropriation of assets. It actually goes along with the personal use of the company's property. So we can also have a case where we have the company vehicle. It is the management that will be in possession of the company's property, such as the company's vehicles. They can be in access of the company vehicle, then they can end up using it for their personal business. Awakenda kumusha ne company car. So that I want these companies are not pressure. Chero kamda kwenda, don't worry, mota ilipo. Chitemba is the company's vehicle. It's actually a fraud that you're committing. Why? Because the company does not put fuel in that vehicle with the intention you eat your personal business. But whatever that they do, they are assuming when they give you that vehicle, you are going to be using it for the benefit of the company. You are going to be using it for the business of the company. So once you start using it for your personal benefit, it becomes a fraud. But this is commonly committed by management because as an employee, a junior employee, I can't window dress the accounts on my own because I have to submit them to the seniors. They have to be verified by the management. So at that level, you are rarely going to find issues to do with window dressing, issues to do with the use of the company's property. Of course, it can occur, but the chances are low because it's normally the seniors that have access to those resources. Then the employees also commit their type of fraud. So which type of fraud is normally committed involving my employees? We have the first one, teaming and lading. So for teaming and lading, what happens is as employees, we can team up to commit the fraud. What organizations have what you call, they can put what you call segregation of duties as a control to prevent fraud. What is segregation of duties? This is, as an organization, we can say, let's not have a situation where one person is doing everything. So we can have one person being the initiator, then they give it to someone else who processes, then the other person who finalizes the transaction. Like if you go to the council offices, when I was processing one of the stands for the school in Shungwizo then, the process took a very long time. But one of the processes, then they tell you, no, after this process, you have to go into the next office. And the next office will tell you something that is totally different from the other office. And they'll be checking their own, fire extinguisher, they're looking at drainage, they're looking at, so you realize that it becomes so difficult for you to commit fraud or bribery because it means you have to pay all those offices. Provided that the system is being applied well, it means it has to go through a number of offices. It's not one office where everything is completed. So that one is actually a control which is put in place so that a plan that does not meet the required characteristics is not passed. But the challenge is that, why did I give the example of the council offices? You realize that most of the issues that you hear, it all emanates from it might involve the council. Through the council, regardless of those controls. So the controls are there to prevent fraud. But even in the presence of those controls, we can end up having fraud being committed. How? This is where teaming and lading comes into place. Even though you have put these into different offices, they team up. They will team up to commit the fraud. So teaming and lading is when these employees now, the fire brigade, the drainage, the finance, they just agree, okay, if a client comes, just charge them $400. As long as you have charged them that amount, we are not going to even look at whatever the plan is there, we are going to approve. Then we share the money. So the controls are there, but they fail to actually work. Why? Because the employees have teamed up. So for teaming and lading, this is a case where the employees have teamed up to circumvent or override the controls which are in place. So that's when there is teaming and lading. Then also we have the scheming of schemes. This is normally common for those that are in the accounting department. So for scheming of schemes, you'll be stealing a very small transaction. So let's say if you are working in the bank, then you decide for every customer, you start stealing 10 cents for every customer. So if you steal 10 cents for every customer, it's very difficult for even the customer to detect. They will just think maybe it's the bank charges. So if you steal 10 cents for every customer, out of 100,000 customers, it means you have actually stolen something like 10,000. Stealing 10 cents. So this involves stealing very small amounts from the transactions. You are taking small amounts from each transaction. In the end, these amounts, they actually accumulate and become very huge amounts. So if the amounts are being stolen and we are not realizing it for some time, it can end up becoming, the organization can end up losing very large sums of money. Then we have fraud that also involves those outside the business, which is third-party fraud. So this is when we are now teaming up with, it could be the suppliers, or we are teaming up, it could be with, so we can team up with the suppliers, we can even team up with our customers. So if it is involving those outside the business, that is third-party fraud. So let's start with false billing. So false billing, this involves teaming up with your, if it's false billing, it involves teaming up with your suppliers. You write a false, they can write a false invoice. They write a false invoice to the company, and the company actually pays the invoice, but nothing was bought from this company. So they write a false invoice and we actually accept it. I'll be the one in the company and I'll say, yes, we did receive these goods, but yes, we haven't paid for these goods, but nothing was actually received. So we pay for the goods that we never received. Then I share that money with the suppliers for the business. So the organization is honored a false bill. Then besides that, we also have advance fee fraud. So we have a case where a payment is made in advance. Actually make a payment in advance, but we pay for the goods that we never get to receive. So the organization makes a prepayment, but no one gets to follow up and see whether the goods that were paid for were received or not. So the organization makes a payment in advance to our suppliers. Then time elapses and we don't receive anything. And maybe I'll be the one that is responsible for following up on the orders and I don't get to follow up. And we actually place another order, the goods get received, but no one gets to follow up on the initial or the first order, whether it was received or not. So that's advance fee fraud. Payments are made in advance, but we are not going to be receiving the goods. Then also we have Ponzi scheme. A Ponzi scheme or the pyramid scheme. Ndo yakarowa vazhinji ne-e-creator, vakarowa pane element, there are quite a lot of those schemes like Vazhinji, I think the dominant one was e-creator, but it was actually not the first. I got to know this Ponzi scheme, there are other schemes before this. And when I also read about the Ponzi pyramid scheme, when I did BT, that's when I understood, no, these things, they end up collapsing in the end. Why? Because in a Ponzi scheme, we are getting paid, but without a business that we are doing. So we are getting paid from the capital that someone is investing. So under normal circumstances, shareholders of a company, they get paid a dividend out of profit. They have a business they have been running, then they get paid out of profit. If you start a business today and you start paying yourself the capital, in the end, the business will not be having any capital. But if you pay yourself profit, the capital will remain in the business. So if there is no business that we are running and we don't have any profits that we are receiving, and we start paying ourselves a dividend, then that is a problem because we are taking the capital out of the business. So under the Ponzi scheme, we are using the money that the new shareholders are paying to pay dividend. It's actually an unlawful dividend. We are paying dividend out of the issued shares, out of the money that we have issued to the shareholders, which is not profit. So what happens is we are adding more shareholders, but no profit is coming in. And in the end, we'll get to a point where we have sold all our authorized shares. And we have no more shares to issue. And at the same time, those shareholders need to be paid. So at that time now, the system collapses. So under the e-creator system, people were getting paid from the money that was coming from the new joiners. What happens when no one is there to join? The system collapses. So that is how the Ponzi or the pyramid scheme works. So this is a type of fraud that is committed involving third parties. The investors, they put their money, then instead of us paying, again, this one involves management, playing around with the money that has been invested by third parties. So they take that money, they issue it as a dividend, which is unlawful. Now, let's move on. So those are some of the types that we can have. So let's have the effects of fraud. So if fraud is taking place in the organization, what are the resulting effects of fraud? What are the issues? Number one, can quickly have that. So the first effect, the company will collapse. Because if someone is stealing, like the issue we're talking about on the skimming of schemes, if they're stealing money, that's 10 cents. If the profit of the company was 30 cents and they're stealing 10 cents, then in the end, the company will collapse. The company will lose much of its profits. So in the end, the company will collapse. That's number one. Then besides the company collapsing, we have also the issue of adverse publicity. So for adverse publicity, we have auditors that come to audit the company. And the auditors do issue out a report on how the company's financial statements are, whether they are true and fair, whether the accounts are misstated. So what happens is, Kanapaine fraud that we have been committing, we are likely going to get a negative report. So the auditors are going to issue an adverse opinion, or they're going to give a qualified opinion, means the accounts are not true and fair. So this report, once it's published, it damages our reputation. It creates a negative publicity because investors they won't be happy putting their money in that company. As an investor, I can't put my money in a company where fraud is taking place because I'm at the verge of losing that money. So adverse publicity, that's another problem we might face. Then also, if there is fraud in the business, we might also suffer the problem of reduced profits because the profits that we were supposed to be making, some of them, they are being stolen by the employees. So we suffer the problem of reduced profits. We suffer the problem of reduced profits. We suffer the problem of reduced profits. And then besides reduced profits, qualified audit reports. I've mentioned this together with adverse publicity. So it means when the auditors come to conduct the audit, our reports are not going to be clean reports. We are going to get qualified reports indicating that the company the accounts of the company are not true. So those adverse reports, they affect our position. Then also we have distorted performance results. They make it hard for managers to make decisions because as managers, we make decisions based on the information that we have. So it becomes difficult for us to make good decisions based on false information. So if fraud is taking place, the managers can, remember it's not every type of fraud that is involving management. It means the managers will make decisions based on wrong information, which can actually result in the company getting worse. So that's the effect of fraud. Are you done? Now let's move. Prerequisites for fraud. So prerequisite for fraud, we have dishonesty, opportunity, motivation. This one. So dishonesty, or in fact, if we say prerequisite for fraud, we are saying what must be there for fraud to take place. Fraud, there must be prerequisites. There are conditions that make it possible, that make it beneficial to commit fraud. So the prerequisites for fraud, So prerequisites for fraud, number one, dishonesty of the employees. If you hire people that are dishonest, you're actually heading for disaster because they won't start becoming honest at your company. So hiring people that are not guided by ethics, that's why maybe hiring someone who belongs to a professional board like ACCA, it might be an advantage. Why? Because they are guided by professional ethics. So if someone is generally dishonest, it's one of the preconditions for fraud to take place. Because once that person gets an opportunity, then they are in for it. So dishonesty, if someone lacks integrity, an honest employee is less likely to commit fraud. If you're dealing with people that are honest, they are less likely to commit fraud. Then another issue is opportunity. So for someone to commit fraud, there must be an opportunity. Sometimes you have not committed fraud or have not stolen money, not because you're a very nice person, you're a very honest person. It's just that you haven't found the opportunity. So don't be just too quick to judge those that have committed fraud because of certain opportunity yekuba 1 million. It doesn't mean kuti ukaiwana mkana wacho uchasiya kuti aiwa inini I'm comfortable with my $200. I am not comfortable with the 20 million. So sometimes it's just the opportunity that you have not yet gained that makes you look like you are an honest person. So sometimes fraud, it also comes from the opportunity. If the company gives me the go ahead to initiate transactions, I'm the one that receives the money, I'm the one that makes the payments, I'm the one that records everything, then I just tell them feedback of how much is left. And no one gets to check. And it has been 5 years down the line, no one gets to check the transaction. So what happens is one day you just say, okay, let me just take $10, I'll replace it. Then you realize no one has identified it. Then the next day, let me just take 50, then it's 100, then it goes on like that. And it gets to a level where you just now do it without even hesitating. So because the organization has given you that opportunity, it might be a room for someone to commit fraud. So having an opportunity, having a leeway to commit fraud, it is also another prerequisite. So before fraud has taken place, we have people that are dishonest. We have an organization that is giving its employees an opportunity to commit fraud. If you are being regularly checked, the auditors are coming regularly, and the transactions, there's someone who verifies, then there are less chances of someone committing fraud. Also, another factor to incorporate is motivation. If someone is earning 150 per month, ovangwana illegal deal, chinoita kuti avangwana 2 million. Ari kutambira 150 per month. Overwana illegal deal chinoita kuti awane 2 million. But akabatwa basa rinopera. So the person might be willing to risk because the benefits are outweighing the cost. But if someone is working at a company where the employee is working there, they're actually one of the highest paid people, and they are working at a company where everyone else wants to work there, they're less likely going to commit fraud because they want to protect their job. But if employees are disgruntled, that they are just complaining, you're going there, you see, you are the first people to commit fraud because once they get an opportunity, then they go for fraud. So there must be something that motivates them. It could be the amount they will benefit because of the fraud, or it could be the organization itself does not check. So there should be something that gives them a motivation. So once the organization gives room for motivation to commit fraud, then fraud is likely to take place. What can we use as auditors to detect whether fraud is taking place or not? What are the signs of fraud? So you are an auditor, you come to an organization, then you want to assess, is fraud taking place in this organization? What are the signs that fraud is taking place? What are the signs? What are the signs of fraud? So what are the signs of fraud? So what can indicate that fraud is taking place? So fraud can be indicated by poor staff morale. So you're an auditor, you come to a company, you ask the employees, how is it? Then they tell you, here, tinongoshandawo bata. Those people are likely to be the ones in front, especially if fraud is to be involved. Because the employees that are disgruntled, that are not motivated, they're likely to commit fraud. They don't hesitate to commit fraud. Again, another sign that fraud might be taking place is where we have very few people that control everything. They don't want others to contribute. They want to be in control of everything alone. So those people might be trying to cover up. So it's just a small team that is responsible for everything. It's just a small group responsible for everything. Then also we have people that do not want to take leave. They will say, I know it's fine. Susu, zema leave is at was fried rice. Susu will leave. And that is when you Susu zema leave. Why? Because they are afraid the moment they leave the office, the next person coming will pick their fraudulent deals. So they prefer not to go for holiday or leave. Why? So as to protect their fraudulent activities. Another sign for fraud is inadequate segregation of duties. Inadequate segregation of duties. What is this? If there's inadequate segregation of duties, this is where one person is doing everything. Like I did mention that one of the controls to prevent fraud, let's give different responsibilities to different people. So we can't have one person doing everything. So segregation of duties, if it's not there, it's a sign that fraud could be taken place. We have one person who initiates, authorizes, and does everything. That's a sign that fraud could take place. Lack of monitoring, no one gets to check. The camera is there, but no one gets to check the footage. The systems are there, but no one gets to check whether they are recording things properly. So lack of monitoring of the control system is also a sign of fraud, because once the employees note that the camera is there, but no one gets to check, they can steal, because the camera will not, Kanawagubai doesn't shout out, hey, you can still steal, irrepo. Then the employees are not, the cameras are irrepo, but no one gets to check footage. They can start engaging in fraud. So lack of monitoring of these controls, it can be also something that can encourage fraud to take place. Then unusual transactions. Normally, it's not trade. It's a business rate. Maybe normally trade transactions. Emari pamwedzi 2,000 tinozibhadhara kunze wenyika tinozitenga inventory of maybe 2,000. But all of a sudden, we have bought inventory of 50,000, and this supply is not our usual supply. Those unusual transactions, they can be a sign. And it being a sign does not just conclude that fraud is taking place, but it's an indicator that fraud may be taking place. So this is now the duty of an auditor to verify that is fraud taking place or not. Now, let's move to money laundering. Let's talk about money laundering. So we have money laundering. Money laundering. So if it's money laundering, this is where clean money is being exchanged sorry, dirty money is being exchanged for clean assets. So exchange of money and assets that have been criminally obtained for clean money and assets that have no clear link to criminal activity. So for money laundering, this is what money launderers do. We can quickly copy that, then we discuss. So what money launderers do is, let's think of someone who robs a bank today. If you are to rob maybe a bank over pamwe pane hesi yakamborwa paplawaya 4 mita yabva yaenda yatotadza kuzikanonzi yakafamba. Let's think of you being part of the team. I know I wangosipo, but let's think of a case that you are part of the team and you are successful marova that 4 million. Let's increase the amount to 16 million and Mamuri 4, and you got 4 million each. What would you do with the money? It's in the news that Pagabiwa 16 million and the robbers are nowhere to be found. What would you do with the money? What do you do, eh? I don't understand. Go on, later say. Sure, we need 4 million. Not that I'm going to understand in 2010. So under a normal system, businesses are not supposed to accept large transactions of cash. If you decide to take that from the 4 million, the moment you start, if you decide to take maybe even 50,000 and you want to deposit in your account, they will start asking you, what is the source of this income? What type of business do you do? Because you don't have someone carrying 50 million cash. So the big business people, normally they use, it could be the bank cards, but they don't move around with large sums of money. They want to understand. The moment you try to deposit the money, they want to understand where are you getting the money. If you decide, let me go and buy a car, a brand new car, not maybe from these car shops. Ukada wenda unotenga necash 100,000. Where did you get the money? Why do they do that? It's because the money laundering rules force them to do that. Because if you accept money, which is a proceed from money laundering, you have also committed money laundering. So they want to verify your source because they want to understand where did you get the money from. So what do money launderers do now? They open a lot of accounts, a lot of companies. Ona any company mazepe, any company anotengesa mafoni, and business network just it must share the business, but every day are going to bank going to say 50,000. Where is the money coming from? I have a business. I have a company that is running this. And so the bank now is not going to be much concerned about what is the source of income. They will say, no, the money is coming from the businesses that the person is doing. And iwe uri kutraya kuda kukopera munhu webhizinesi ratara but iye ari kunzi ari kuita mamillions naro bhizinesi iroro but iwewe hauna kana mari nemusoro iri kumbooneka uri kuti and you think maybe it's my strategies wamachinja but here what they're doing is kana aita $20 from the business ari kubva anotora chi $200 from the money that they store ozvibatanidza akunoti imari yabva from the business. So if the money launderers are successful in depositing that money in the bank, that is the stage which is crucial, that if we fail to detect money laundering at that stage, it becomes so difficult to pick it at the other stages. So what they do, once they deposit the money in the account, they transfer it from one account to the other, then back to the account. When they are now receiving that money back, no one can be able to tell the initial source of that money. So then they withdraw that money, they start buying the assets from that money, and you say, no, this is money coming from their account. They will even pay using their bank accounts, and no one gets to wonder. But kwatangira mari yacho, the source was where fraud took place. But kana yakuba from the now from the bank, everyone believes it's from a clean source. It's coming from his bank account. I can even show you, but what made it get into the account is the fraud. And so fraud in 3 phases. We have placement. This is where the funds you have stolen, you try to put them in the legal channel. You have stolen the money, you are trying to put them into the bank. That is placement. You are wiring the money into a legal system. Trying to wire the money into a legal system. And trying to wire the money into a legal system. So if you are successful with placement, the money launderers, they then transfer the money from one account to the other. Because if you keep it in one account, it will be too suspicious. So they transfer the money from one business location to another. Then we get to the integration stage, where that money is now being received back, and it looks like it's now clean money. Then we now invest it, sometimes in the property of the company itself. We are reinvesting that money in the business. So unoona unoromba uchikombita nemunhu ari kuita money laundering dzake zvakane zvinomupa mari, iwe uri kuzongoona ane mari, hausi kunzwisisa the originating source. Now let's move on quickly. Can you copy that? Those that are still copy. Phases of money laundering. Okay, can we move on? Then there are crimes under money laundering that someone can commit. So committing a crime under money laundering is not only if you are to steal the money. The reason why the banks ask you the source of the funds, the reason why if you try to buy, maybe buy a brand new car, they might want to understand the source of the funds. Why? Is because they are also regarded as having committed money laundering if they just accept that money. So laundering, there is a crime for laundering. That is being in possession of laundered property or being the one who has committed the laundering. Then the other issue is failure to report. You were aware that laundering is taking place, but you kept quiet. So being aware that there's money laundering taking place and yet you don't report is actually a crime as well. So the crime is not just money laundering. Being aware that laundering is taking place and you don't report, it can also put you in danger. So we also have failure to report as a problem. Then besides failure to report, we also have tipping off. If someone is being suspected of money laundering and you become aware of it, so you're not supposed to tip off someone who is committing money laundering. You are not supposed to tip off someone who is committing money laundering. So tipping off is also a crime under money laundering. Tipping off is a crime under money laundering. Then let's move on. Let me check something there. Can we add insider dealing? It's not there. Can we add insider dealing? Insider dealing. This involves dealing with price-affected securities. Dealing with price-affected securities. Due to possession of insider information. In other words, we're saying, on an information that others don't have yet. So you are the accountant of the company. Ndiwari kutoziva kuti pane zvatinoda kuita next month. Zvichaita kuti share price yecompany ibva yakwira. Then wobva waadvisa hama yako kuti shamwari tenga mashares izvozvi. Company yedu, they are going to do something that is going to result in the share price increasing. So if you buy shares now, they are likely going to gain 5. So if that person buys the shares basing on that information and the shares gain value, they have committed a crime of insider dealing. You, the person who have told the person, and the person that has bought the shares, you have committed insider dealing. So let's close with the responsibilities for preventing fraud. Who is responsible? Who should make sure that fraud does not take place? Who has the responsibility for preventing fraud? Who has the responsibility of preventing? So the responsibility of preventing fraud lies with, number one, the director